Okay, during this video I'm going to explain how to understand a set of property investment accounts. So property investment accounts differ quite a bit from standard company accounts, and so this video will go through some of the intricacies of what you should be looking for if you're a property investor when your accountant shows you your property investment end of year accounts. So this is what I'll cover. Firstly, I'll talk about what kind of submissions, including your accounts, you need to make as a company director with a limited company. The two different main types of accounts for property investment companies that we'll come across. I'll then go into a bit of detail of the profit and loss statement in a set of accounts and what that means and things you should look out for. I'll then talk through the balance sheet, again things you should look out for in your set of accounts. And I'll briefly cover tax returns and computations. So starting off then, what submissions do you make? So you've set up a property investment company. These are the sets of submissions you need to make as a company director. So firstly, it's the annual confirmation statement. So basically once a year you need to submit a return to Companies House, which basically provides an update on information about the company, particularly details of the directors and the share structure of the company. There's a couple of ways you can do that. You could either get your accountant to do this for you, probably for a charge, or you can do it yourself via the Companies House website. It's fairly straightforward to do. There is a small charge involved, which has recently gone up as Companies House have increased their prices. But yeah, it's a straightforward thing. It's required once a year. It just provides an update on the company. Okay, the second thing you need to do then is you need to submit end of year accounts, so statutory accounts. And there's basically two different masters that they need to go to. So you've got Companies House, who kind of keep a directory of all the companies in the United Kingdom and information on those companies. And you've got HMRC, which is obviously the Her Majesty's Revenue and Customs, or His Majesty's Revenue and Customs, which basically collects taxation from companies. But basically, you've got these two different masters, Companies House and HMRC, and they don't actually talk to each other, and you need to submit separate submissions to both of them. So you need to complete an annual set of accounts which go to Companies House, and you also need to send a set of annual accounts to HMRC, and that will include a corporation tax return, which basically shows a self-assessment of how much corporation tax you need to pay, and it will also include a computation, which basically is basically takes your accounts and works out from there how much taxation you need to pay, and it makes a few adjustments as you go through. So they're the key sets of submissions you need to make on an annual basis. So your annual confirmation statement once a year, your set of your annual accounts to Companies House and to HMRC, and to HMRC a corporation tax return within computation showing how you've calculated the taxation that you owe. It's really important you get these in on time, because otherwise you're going to face penalties and fines. Cool. So we come on now to the different types of accounts. The two, probably the most likely ones you're going to come across as a company director. So basically, depending on how big your company is and some of the metrics of the company will depend on what kind of accounts you would need to submit. So the first one I'll cover then is FRS 105, which is the reporting standard microentity. You basically, to be classed as a microentity, you have to meet two of the following characteristics. You have to have a turnover of £632,000 or less. You have to have £316,000 or less on your balance sheet, and 10 employees or less. So basically, if you had two of those characteristics, you could be classed as a microentity. And basically, microentities have more straightforward reporting requirements. They don't have to make as many disclosures as a small company does. So it's much more straightforward and simple to report as a microentity. But there are some issues with it from a property investment perspective, which I'll come on to. The next one then is FRS 102, which is the reporting standard for small companies. So you class as a small company if you meet two of the following characteristics. a turnover of 10.2 million or less, 5.1 million or less on its balance sheet, 50 employees or less. And basically, small companies have more disclosures and requirements in terms of their accounts than microentities do. You can understand why that is, because they're bigger. They have to basically report more things to in their accounts, and they're a little bit more complex to produce a set of accounts for a small company than a microentity. So I think you can see from those characteristics, I think certainly most property investment companies, when they start up, are probably realistically going to be classed as a microentity in terms of the characteristics they meet. I mean, if you're really lucky, you'd hope that you would get to have a £316,000 or more on your balance sheet, particularly if you're building up significant numbers of properties over the years and through revaluations. However, it's probably unlikely you're going to have 50 employees, more than 10 employees. I would even argue any real employees in a property investment companies. So it's likely that actually you may stay as a microentity, but then at some point you may then become a small company. However, there's a key difference in both in how they report on property investments or investment property. And basically, the key difference is with a microentity, the property investment is held at cost. So it's basically what you purchase the property for plus any capital expenditure for that property, so things like solicitors' fees, etc. The property value basically remains that going forward. It isn't amended every year, and actually we look at depreciation for it, so it might actually reduce in value. The difference is with a FRS 102 small company, we have to do revaluations of the property. So basically, the directors will, or either through evaluation or through their assessment of the fair value of property, annually there's a requirement to revalue the properties and basically adjust them on the balance sheet. So that's the kind of key difference. And arguably, my argument would be that as a property investment company, it'd be more appropriate actually to report as a small company, noting that values of property go up over time, and so actually to show a true and fair reflection of the actual value of the company, you need to report as a small company. Okay, that is open to debate, and you could report on as a microentity, and it wouldn't be wrong, but you just wouldn't show a fair reflection of the value of the property portfolio. And actually, this could become an issue if at some point you were looking to raise finance against your portfolio. If you're telling them you've got these properties, they're worth this much, and they look at your accounts and there's a big difference because they've been held at cost and haven't gone up in value, then that could cause issues with getting finance potentially. So yeah, essentially, I think it's more appropriate to report a property investment company using a small company regime, even if it meets the characteristics of being a microentity. But your accountant may have a different view. But yeah, you definitely want to speak to them beforehand just to confirm which reporting standard they'll be using, because there are implications based off what I discussed about revaluing the properties every year or not in the case of a microentity. So there are two types of accounts that most of you will come across: FRS 105 microentity, FRS 102 small company, and they have different ways that they value properties. So what I'll move on to now then is I'll talk through a profit and loss statement, and this is for a small company. So this company in particular met the characteristics that could have actually reported on as a microentity. However, it was more appropriate to report on as a small company, and so that's what I'm going to use the demonstration for. So all of the property investment companies I report on, I use the small company regime. Different accountants may have a different view, but I think it's more appropriate. And so that's what I'll be talking through in this demonstration. So basically, profit and loss is very straightforward. It shows the income the company makes and the expenses it has to endure as well. So it's got income and then expenses, and it works out then at the bottom what the kind of profit or loss is for the year. And so what you'll see is if it's a company that's had at least one previous set of accounts, you'll basically have two sets of numbers going from top to bottom. So you'll have on the right hand side the comparative figures from the previous year, So in this case, the reporting period that ended the 31st of August 2022. And then down the left-hand side, you'll have the figures from the current year that you're reporting on. So it's in this case, 31st of August 2023. Going from the top then, we'll start off then, all profit and loss statements will begin with turnover. So this is sales. This is the income the property makes. Kind of key difference with a property investment company is if we talk about rent receivable, it isn't necessarily the amount of rent you receive. The easiest way to describe it is it's the amount of rent you should receive in a year. So if your tenants pay on time, it's how much rent you should receive rather than how much you actually receive. So potentially if there's a case where you've got a tenant who's in arrears, you would still complete the rents receivable figure as if they'd paid the full amount, and then you'd have to then make an allocation in the balance sheet for the amount you're actually owed by that tenant. That's just a kind of key thing to consider. Once we go below rents receivable then for the property investment company, we come into cost of sales. So this is direct expenses for the property investment company. And so key kind of direct expenses for a property investment company are things like rents and rates. So this would be things like utility bills you might have to pay if there's a void in your property. Same thing for council tax as well. You've then got insurance costs. So obviously it's a key requirement for you to insure your properties, and this is therefore a direct expense for you to do business. You've got repairs and renewals. So this is the revenue expenses that you conduct for conducting refurbishment of your properties. They would have a different treatment if they were capital expenditure, and they would be put on in the balance sheet. But yeah, assuming they are revenue expenses, they're an offsettable cost, and therefore they go in the balance sheet and they're a cost of sales, so a direct expense. Letting and professional fees, so particularly if you use managing agents, their expenses will go in there. One thing to just be careful of, if you do use a managing agent, you'll probably find, in fact you will find, they will pay you basically a net rent figure. So they'll take the rent off the tenant for you, and then they'll deduct some fees, so things like their own fees and also things like maintenance, and then they'll pay you a net rent figure. It's really important if you do use a managing agent that you make an adjustment in your accounts to reflect the full amount of rent you received and the expenses that they deducted at source. Otherwise your account's essentially understating the amount of property investment income you've received and the expenses you've endured. So that's a really key one. Premises costs. So I think in this case it's for use of home as an office for directors, but you could have an office facility used. It will then show you the gross profit, or in this case a loss, which is basically the income less cost of sales, and that figure in this case is negative. So in this case there's a loss. It's not unusual for property investment companies to be loss making initially. It's a really capital intensive business, and refurbishments are expensive, and actually you may be loss making initially, as in this case this company is. So once we've worked out then the gross profit or loss, we move on to admin expenses. So this is indirect expenses of the property investment company, and so examples include in this case staff training, computer running costs, office admin costs, accounting fees, and sundry, which means other, but there could be a whole host of other things in there which come under admin expenses. Basically those expenses that are not directly essential to the running of your business, which will be treated in the cost of sales, but that's the easiest way to describe it. Once we have admin expenses, then we'll come to an operating loss figure. In this figure, it's an operating loss rather than operating profit. Essentially operating profit or loss is gross profit or loss less admin expenses. So we have below that in this case, so remember it being a property investment company that's reporting on using FRS 102 as a small company regime. We're going to be revaluing the the properties on an annual basis. In this case, there's obviously been an increase in the value of properties, and that's shown there. Amounts written off investments is the revaluation of the properties to fair value. So that has to be treated in the go through the profit and loss statement, because it's even though it's an unrealized gain, it has to be treated as go through profit and loss to meet the requirements of the reporting standard. So that's what you can see there. Amounts written off investments is property revaluations. We then have below that interest payable and similar charges. So this is where we have bank charges, so which could be cost for using your bank account on an annual basis. I'd definitely recommend, if you're able to, try and use a bank which doesn't charge you every month to use their services. For example, one of the challenger banks like Starling don't charge you. However, if you use one of the kind of more standard banks, you might find you have annual fees, monthly fees, which you have to pay, which are captured here. You've got other interest there. That is the figure for your mortgage payments. Also the interest part of the mortgage payments if they're capital and revenue. Capital and expense. Interest and capital, then it'd be slightly different. But in this case, either case, the interest part would go on here. And actually, most property investors will use interest-only mortgages. We then have finance charges below that. So finance charges are the costs for arranging finance for your property portfolio, and they'd be captured here as well. We then have below there a profit or loss before tax. In this case, is a profit before tax, and this basically works out, basically all the kind of categories above. It works out the profit or loss. So it's basically the turnover less the cost of sales, less the admin expenses, plus the amounts written off investments, less the interest payable and similar charges, and that gives you the profit before tax figure. And we can see there that the property revaluations basically increase the amount of income in the company, and therefore that's why it's got a profit before tax figure. We've got below there then tax. So it might be if there was a requirement to pay corporation tax, that would be included there. In this case, there's not. That'll make more sense when I come to the computation in this case. But there is a deferred taxation figure that's being calculated, and so linking back to those property revaluations. So we can see there the property portfolio has gone up by £56,000, just over that. So there's been some increases in value of the properties, and they've been treated correctly within the accounts. Because they've gone up in value, even though it's an unrealized gain, so actually you're not going to see the benefit of that gain unless you would come to sell the property. We have to track something called deferred taxation. So deferred taxation is when an asset increases in value. It's the amount of taxation you would then pay if you would come to sell that asset, in this case the investment property. So that's something we need to track when we use FRS 102 small companies regime. Okay, so that deferred taxation figure has been calculated based off the amount of property revaluation, and that will then also go onto the balance sheet and join on with deferred taxation from previous years' revaluations, if there were any. So that's really important. Deferred taxation and property revaluations are only applicable for FRS 102 reporting. And then, so after we've got taxation there, we'll have a loss or profit for the year. So in this case, there is a loss after tax figure because the deferred taxation figure has brought us down to a loss for the year. That's really the profit and loss. So I've gone through everything from top to bottom, and hopefully that kind of brings things to life a little bit. The kind of exact breakdown of things might be different depending on how your accountant set things up, but all sets of accounts should look fairly similar. It'll be a little bit different if it's if it's reported on using FRS 105, the small companies regime. I think another thing to mention as well is this is a trading profit and loss statement, which is a lot more detailed. So you normally find this at the end of your accounts. The actual profit and loss on your accounts will be a simplified version of this. So it'll just have the kind of key categories, but it won't be as detailed. So always try and look at the trading profit and loss statement as it'll break down each of the different expenses in more detail. So it makes a lot more sense when you read it. Okay, so that's profit and loss. Let's move on to the balance sheet. So very simply then, a balance sheet shows what the company owns and what the company owes. And as per the profit and loss, we'll have down the right-hand side comparative figures from the previous reporting period, and then down the left-hand side we'll have the numbers from the current reporting period that we're reporting on, assuming it's had more than 1 year of trading. So let's go from the top then. So for a property investment company, investment properties and fixed assets are going to be at the top, and so you can see there that the investment properties have gone up in value from the previous year. That's probably too big to be the case. It's just from revaluations, noting the number we had for revaluations on the previous slide. It's going to be because the company's bought new investment properties. But yeah, that's the value of the investment properties. And once we've got the value of the assets below that, then we'll have the fixed assets. Below that, we'll have current assets. So debtors, and that's if basically anyone owes the company any money. We've then got cash at bank and in hand. That'll be the amount of money you've got in your bank accounts. We then below that have creditors, amounts falling due within 1 year. So a creditor basically is somebody that the company owes money to. If it's a creditor, amounts falling due within 1 year, it's basically a short-term creditor. So it's something that has to be paid back within the next 12 months. So for a property investment company, that could be, for example, a bridging loan potentially. That could be a year or less, the likely time frame you'd pay it back. It could also be short-term financing, but importantly for property investment companies, often the director's loan account, so the amount of money that the company owes back to the director, is classed within creditors' amounts falling due within 1 year. So that's the reason why that figure can often be quite high within a property investment company. And it can be a little bit misleading because it's a little bit different to owing money to a director who has the interest in the long-term value of the company than owing money to, for example, a bridging lender where it has to be paid back, otherwise the property can be repossessed. So it can be a little bit misleading there. We then have below that net current assets or liabilities. And basically that means simply it's the value of the current assets less the current liabilities. And very simply it shows the liquidity of the company and how easy it can pay off its short-term debts. As mentioned though, with a property investment company, it can be a little bit misleading because even though on the face of it this is showing that this company in particular is going to struggle to pay off its short-term debts because its current assets are significantly less than its current liabilities. Actually, the bulk of this company's current liabilities are the director's loan account, and so therefore it is a little bit misleading because of this fact that it's a director the money is owed to rather than like a bridging lender, for example. We then have total assets less current liabilities. And this is a metric which basically shows how well a company is investing its assets. And if it wanted to, it had to sort of sell its assets to pay off its short-term liabilities, how easily it could do. So it's, in this case, we can see we're in a fairly healthy space because company's got significant assets. If it needed to, it could liquidate some of those assets to pay off some of its short-term debt. And so it's in a reasonably healthy position here. It's all, another way this is known as is capital employed. You might hear it referred to as capital employed. It means the same thing. It's basically total assets less current liabilities. The next one we have below that is creditors, amounts falling due after more than 1 year. So this is long-term creditors. So for a property investment company, realistically, that's most likely going to be money owed to banks in the form of mortgages. So they're long-term creditors. And so a little bit of a different risk profile to short-term creditors because you've got longer to pay them off. And so that figure for a property property investment company is probably going to be quite high unless you're lucky enough to not need to use mortgages to buy your properties. Below that, then we've got provisions for liabilities, deferred taxation. So linking back to the previous slide, we had a deferred taxation figure for the property revaluations from this period. That figure is then added on to deferred taxation figures from previous reporting periods. It's collected all here, so it shows how much deferred tax the company would need to, how much tax the company would need to pay if it was to sell its assets. Next, then we come on to net liabilities. So it could also be referred to as net assets. It's basically all the assets less all the liabilities. You can see in this case, the liabilities are greater than the assets. Bear in mind what I said about the director's own account will also skew this figure. And actually, what we'll see is that over time, as the values of the property go up in value, this figure will become positive, or hopefully it will become positive, because the assets will outweigh the liabilities significantly. Then come on to capital and reserves. We have there the share capital, which is when we have the profit and loss account, which we can see is negative in this case because the company is being loss making, and so hopefully again this figure will become positive over time, and that will mean potentially, depending on how the profit is made, whether it's profit from your kind of rental profit, and then hopefully at some point you'll be able to pay out dividends. But because this figure is negative, currently we're unable to pay out any dividends. Then at the bottom there we have shareholders' funds. And the easy way to describe this is the amount of equity you've got in the company. If you were to sell the company, this is what will be left. And you can see this is a negative figure currently. Hopefully this will become positive over time as the values of the properties increase. So that's a balance sheet. It's a rundown of the balance sheet for a property investment company. What I've done now is, I'm not going to go through an entire tax return because that would take a long time, and I don't think it would be particularly interesting. But for the example we've just shown, I wanted to show an example of computations. This is some extracts from the tax computation just to show how corporation tax is calculated in this case. Move my head out of the way a little bit. And basically what happens is you take profit before tax as per the financial statements, and then we have to make some adjustments. So in this case, we talked about those property revaluations. They're an unrealised gain, and so they're not valid for working out corporation tax. So what happens is that's deducted then, and actually what happens there is we go from a profit before taxation figure. Once we take off that property revaluation, the company is actually loss making for the year, and therefore there's no corporation tax payable. And what we can see below is, you can see there the losses. So the loss of 47,792 is added on to losses from previous periods, and that's carried forward. So with a property investment company, it's quite usual to be loss making the first few years, but those losses can get carried forward to offset against future rental profits. So to further point at which you start paying corporation tax. Okay, just to summarise then, hope you found that useful. I've basically just gone through a set of property investment accounts because they are slightly unique to standard accounts. I've talked about the type of submissions you need to make as a property investment director of a company. So you need to make your annual confirmation statement. You need to submit an annual set of accounts to Companies House and to HMRC. And the HMRC accounts have to include a computation and tax return as well. I talked about the difference between small company and micro companies, and basically the key takeaway is that even though you might meet the characteristics of being a micro entity, a micro company, it might make more sense as a property investment company to still report on as a small company, and that's because micro companies and small companies have different ways to report on property investments. With a micro company, the value of that property basically stays the same and is depreciated. For a small company, though, it's revalued every year, and that's going to mean that over time your accounts give a kind of more accurate reflection of the actual value of your property portfolio than with a micro entity. I then talked through a bit of an overview of how a profit and loss statement and a balance sheet would look for a property investment company. I've talked through I've showed some of the snippets of how the computation is worked, which basically will take the profit before tax figure and then make some adjustments to work out how much corporation tax is payable. Anyway, hope you found that video useful. If so, please can you give us a like and then also subscribe to more similar content.